It's a combination of factors. The first and principal driver is the continued asset management of the portfolio. This is a sort of 365-day-a-year production, extending leases, settling rent reviews, and picking up some of the rental growth in the market. So that was a large part of the increase. We've also benefited from increase in values, particularly in the industrial sector. The industrial sector makes up 45% of our portfolio, so that had a bearing. And through the year, we have issued £91 million of new stock at an average premium of 5.1%. So those three factors combined have added to NAV. Well, it's more of the same, really. It's maintaining a high occupancy rate. After all, we are producers of rent, and having fully let portfolio is very important. We're about 98.5% fully occupied, and that combined with some steady rental growth is driven earnings. Broadly speaking, if you were to drill down into the numbers, what you would see is that there has been an increase in the weighting towards industrial, and that's partly through a concerted effort to continue to buy in what I would consider to be our favourite sector. But also we have reduced weightings to the alternative sector, that sector that is neither an office nor an industrial building nor a shop, but covers a pretty broad range of commercial properties to include restaurants and leisure, so gyms, children's day nurseries, the motor trade sector. And those sales were not because we didn't like the assets, but there were particular reasons in 3 instances where we sold to owner-occupiers, special purchasers, and also took advantage of the very strong market for long-term secure income. So not only did we actively increase the weighting to industrial property, but we reduced the weighting to some of the other sectors. But broadly speaking, it's been consistent since IPO 3.5 years ago. A strong weighting to industrial, a relatively low weighting, and relative to our peer group, weighting to offices, and then pretty even between sort of retail and the alternative sector. Absolutely, and this has been one of the things that I've been quite surprised about in a market that has been incredibly competitive, that by continuing to maintain our focus on sub £10 million assets, we have seen opportunities, and in the last 3 months, we have either terms agreed or completed on £56 million worth of property. Those properties in an average lot size of about 4.5 million and an average net initial yield of 6.9%. So that's bang on target, in fact, slightly better than target for the sort of assets we're looking for. So the opportunities are still there. It is a very difficult market to find those opportunities, much tighter than it has been for some time, principally driven by people not wanting to sell. Property remains an attractive asset class, and people do not want to sell income-bearing assets in a market that's devoid of income. We're still well funded. We've got undrawn revolving credit facilities. We have a £15 million 15-year fixed rate debt facility, which is agreed but not yet drawn. Those two facilities together give us capacity. If you look at our current loan to value, it's 20%, target of 25%. So we've got some capacity within the investment strategy as well, but the undrawn debt facilities to cover that continued acquisition. Everyone's favourite question, and one that I will try not to give too much of a political answer to, because it's not an easy question to answer. The market's very broad. We focus on regional property, and if you look at industry-wide data, it includes Central London, which is a big swing for the numbers. And in Central London, we're probably seeing some rental decline. But in the regions where rental growth is being driven by a lack of supply, we don't see anything that's fundamentally going to change that in the immediate future, because there is still very limited speculative development. If you were to take some hard numbers, CBRE reported numbers for Q1 of over 7% per annum rental growth in the industrial and logistics sector, and 2.8% across the board but that does, of course, include all sectors. If I was to put a number on our portfolio, knowing what we know today, and what we know today is we don't know what's around the corner, 1.5% to 2% per annum wouldn't be an unrealistic number. The company's very clear strategy is to maintain sustainable dividends and to see continued dividend growth where conditions allow. The dividend that is in prospect, we foresee that will be fully covered. I think there's further capacity. As the fund has grown, we've reduced the ongoing charges ratio. That's certainly made for some additional headroom. We've also got a significant amount of our debt fixed for the long term at very low cost of debt, average cost of debt at around about 300 basis points. So there's plenty of capacity for further dividend growth as things stand at the moment.